When you thought things couldn't get any worse, Xpeng Motors and NIO both reached new 52-week lows last week. Now you may be wondering why on earth these Chinese electric vehicle firms are collapsing when we know the Chinese economy is likely to enter an expansionary period in 2023 and when most of their growth is already maintained and predicted to be robust for 2022. Well, that's what we're going to answer in this video. But as always, guys, before we get into it, make sure to give us a thumbs up and click that subscribe button if you haven't already. Let's begin by discussing the harm that has been inflicted against the electric vehicle industry in China during the past 2 months. Even though the company's fundamentals have been very strong with new product launches and even their first flying car test, just last week, Xpeng Motors has been leading the decline to the downside ever since June and July of this year. NIO and Li Auto have also been experiencing a significant decline during this time. The share prices of a large number of Chinese enterprises, including a few of China's manufacturers of electric vehicles, are taking a severe beating today. Last week, shareholders of NIO, Xpeng, and Li Auto saw their stock prices fall by double digits. Shares of NIO have fallen to 20.6%, those of Xpeng have dropped 18.8%, and those of Li Auto have dropped to 24.1%. These names are responding to the news that Chinese President Xi Jinping has secured a third term in office and appointed a number of loyalists to high leadership positions at the Communist Party Congress. Investors are concerned that this might have a detrimental impact not just on individual Chinese businesses but also on the economy of China as a whole. The issue with these stock prices is not related in any way to the company's operations. Rather, the issue is entirely attributable to the macroeconomic climate and political climate in China. You have to understand that the very first thing that frightened a lot of investors in China recently was the fact that they delayed the publication of their GDP numbers. The fact that they are delaying the release of the GDP numbers is most likely an indication that they are not very good. This is most likely the case because elections are currently taking place, and Congress is also currently meeting. The stock market despises uncertainty, so the fact that these events are currently taking place is also likely a factor. It implies the continuation of Xi's zero-COVID policy that has led to lockdowns. These lockdowns have crimped both supply and demand in some areas. Xi has also sought to regulate the tech industry and attempt to restrict wealth inequality by clamping down on some successful businesses and their founders. But investors also are reacting to other news that is unique to the EV industry. Recently on EV Bellwether, Tesla made the announcement that it will be lowering the pricing of certain automobiles sold in China. This comes as a result of Tesla's recent update to its facility in Shanghai, which can now build more than 1 million vehicles annually and has the ability to do so. Some investors are of the opinion that the price drops may indicate a demand problem, which would have a significant negative effect on domestic EV manufacturers. However, in addition to these suggested causes, the new prices might also be due to other factors. According to the Wall Street Journal, Tesla has reduced the pricing of its Model Y and Model 3 automobiles by around 9% and 5%, respectively, for customers in China. If the reason is a slowing demand, it comes at a particularly bad time for companies like NIO, Xpeng, and Li, which have been adding new models and are working to earn profits for the first time. After successfully navigating the difficulties brought on by the lockdowns connected to COVID, these firms had a successful third quarter in terms of revenue. When compared to the same period in the prior year, NIO supplied 29% more automobiles during the third quarter. Both Xpeng and Li Auto raised their shipments by 15% and 5%, respectively, as compared to the previous year. The initial shipments of NIO's E5 mid-size car were included in the record quarterly deliveries that were achieved by NIO. In September, Xpeng began delivering its new G9 SUV, while in the same month, Li Auto shipped 10,123 of its new L9 SUVs. Xpeng's new SUV is an all-terrain vehicle. The global reputation of China might be detrimental to electric vehicle sales in Europe, which is a key market for Chinese EV manufacturers. Moreover, 9% of Li Auto's worth was wiped off, while about 10% was locked off of NIO and Xpeng. The stocks are neither lucrative nor inexpensive at this time. While NIO and Li are valued at more than 3 times their yearly sales, Xpeng trades at around 1.5 times their revenue. The yuan, which is China's national currency, is not helping the situation. In January, it traded at a rate of 6.38 to $1. The recent trading activity saw the price reach 7.26. This means that the value of sales and earnings, when translated to investors from other countries, is lower. The good news is the falling yuan makes these cars more competitive in export markets. The yuan's fall against the Norwegian krone, for instance, could drop the base price of NIO's Xpeng in Norway. The country is important for the EV maker because its car market is dominated by high-end electrics. The Chinese economy is currently experiencing a variety of issues, one of which is the resurgence of the COVID-19 virus, which has led to the closure of large cities like Shanghai. Shenzhen, China's innovation powerhouse, has implemented COVID limitations during the past several days, and even the megacity of Chengdu went into lockdown due to an incident. As a direct effect of China's zero-COVID policy, even if it appears that certain cities have reopened, consumer mood is still rather weak, and uncertainty is still prevalent. The world's second-largest economy is also dealing with a power shortage, which is having an effect on the availability of charging stations for electric vehicles. There is a lot of politics going on in China's electric vehicle stocks right now, which may be beneficial for investors who are trying to buy the drop in the near run. Electric cars are still poised to take the industry by storm. The premium segment of the market is now the most lucrative, and all 3 Chinese businesses are actively competing in it. There is a risk that escalating tensions with China might result in these equities being delisted from exchanges in the United States, which would make it more difficult and expensive to trade them. Despite the fact that it is unknown how well China's economy will do during President Xi's 3rd term, it is possible that the price change made by Tesla is not an indication of a slowdown in demand right now. Prior pricing hikes were implemented by Tesla and other electric vehicle manufacturers in China due to the rising costs of raw materials. Steel and battery materials are 2 examples of commodities whose prices have decreased since the beginning of this decade. Do you think China's electric vehicle market still has a chance to come out on top, or will their economy really crash this time? Share your thoughts in the comments section. If investors are viewing Tesla's action as a demand problem in China, then today's stock price declines could be excessive. However, investors have every right to be worried about the long-term consequences of China's leadership. We hope you enjoyed our video. Remember to give us a thumbs up and subscribe to our YouTube channel. Have a great week.